Good morning. My name is Lyndsay Fincher, and I am a senior associate in the business group at BoyarMiller. I want to welcome everybody to the state of the real estate markets, a look at what's ahead. The reason for our webinar today is that we really want to shift the conversation from COVID-19 and politics to getting back to what's happening in our businesses today and what can we expect ahead. We brought in some industry experts today who've been longtime clients: Jonathan Brinden, the CEO of Midway, Trey Odom, the CEO of Avera Companies, and we also have Justin Boyar, the Director of Marketing Analytics at CoStar. So this has personal interest to me because these are the conversations that I'm having with clients daily. There's a lot of dialogue around it. And as we find ourselves living in this funny co-opsing situation, I'm having these conversations with my husband and father-in-law who are also in the real estate market. So I'm excited to have this conversation and see what's next. So for the flow today, we're going to first talk to Justin Boyar. He's going to give us a little bit about the forecasting that CoStar is doing, as well as the messaging and trends of the economy. And then we're going to talk to Justin and Trey about how it was in 2019, early 2020, what did they expect in 2020, and then where we're at now. And then most importantly, at the end, we'll wrap up with what do we expect ahead. I want to go ahead and introduce the panel. Oh, first, there's a Q&A button at the bottom of your screen. Please submit questions throughout. We'll be addressing it at the end. So without further ado, I want to introduce our panel. Again, Jonathan Brinden, CEO of Midway Companies. Also special today, Jonathan's being honored by Search for his work in the community. So join us in congratulating him. And then we'll introduce Justin Boyar, the Director of Marketing Analytics at CoStar, and then Trey Odom, the CEO of Avera Companies. So Jonathan, do you want to kick us off?
Sure. Good morning. Great to be with everybody today, and I hope everybody's well and safe. I'm Jonathan Brinden, CEO of Midway. We're a Houston-based real estate and investment firm. We largely are known for or specialize in mixed-use development. Our portfolio is largely based in Houston, but currently expanding into other major Texas markets. And we'll talk about it a little bit more later, but we obviously are huge believers in mixed use, but in a time like this, it also creates an exasperated situation in having to deal with every product type. So again, look forward to the conversation today.
And then Justin.
Hi, everyone. It's great to be with you today. My name is Justin Boyar. I'm the Director of Marketing Analytics for CoStar Group's Houston office. And CoStar is the largest provider of commercial real estate data and online marketplaces. And in my role here, I serve as a market economist covering Greater Houston and Greater New Orleans. And soon we'll be covering Spain out of our office, owing to the dual citizenship of our senior market analyst. So in my role, I monitor changes in the national and local economy and its effects on local commercial real estate. And separately, I'm also serving on a number of global product development committees, helping design new software for CoStar LoopNet. So I'm happy to be here.
All right, Trey.
Hi, good morning, Trey Odom, head of Avera Companies. We run primarily industrial and primarily in Texas. We have an investment side, a development side, and a construction group. Industrial has been very busy, and we're looking for new markets today beyond Texas, but that started at about 2018. So glad to be here. Thank you.
Thanks, Trey. We appreciate it. So Justin, we're going to kick it off with you. So we want to hear about the economy. Like Jonathan said, we're interested in hearing what you have to say. But first, CoStar has to be getting a swirl of data, ever-changing data. How is CoStar handling forecasting right now?
Sure, absolutely. So typically in normal times, we update everything every quarter. And what we've been doing since all this started in mid-March is we've been updating our forecast every 2 weeks. So as of this weekend, we'll have updated the forecast 3 times in 6 weeks. And, God bless our quant teams, because from what I understand, it's a pretty heavy lift to turn the ship around every quarter, let alone every few weeks. And typically we rely heavily on our partner, Oxford Economics, for their metro and industry level forecast. We combine those with our historical data. But we kind of jumped the gun this last time. We went ahead and just took their national forecast and took it down to the metro level. They are releasing their new guidance today for the metro level. So we'll be running another forecast this weekend. And our group has, basically been pumping out that same quantity of new videos and reports. And we've seen a big influx in client calls, which we think is good. And we're happy to be here for our clients.
So Justin, you have the admirable position of telling us the trends in messaging and the economy. We kind of talked about there were some dark times, and so I don't know if you can spin anything positive in there, but what are you seeing? What are you hearing?
Sure. So the new unemployment claims data came out today. We added 3.8 million job losses to that. So, there's been 32 million job losses at the national level, which is staggering. In Houston, that would be something like 400,000 over the last 6 weeks, which is also staggering. Our Oxford baseline scenario predicts we get to 500,000 this quarter and recover to about 200,000 job losses by the end of the year, which would eclipse the financial crisis, certainly, and it's nothing like we've seen since the Great Depression. So it's very clear we need to get this virus under control and also get back to work. It's a tricky thing. Our models are simply not built to handle 15 to 20% national unemployment. So we had to do some pretty serious tweaks to make that work. We do think that hospitality and retail will be getting hit the hardest, that are the tip of the spear in a lot of ways, that half of the job losses will be in the service sector, and that there's much less risk for things like industrial and even office because of long-term leases, data centers, telecom. Houston faces some pretty uphill, challenges related to energy and coronavirus and global trade. But, our house view is that we don't think Houston is as at risk as the markets that are more exposed to tourism, like Las Vegas and Orlando and even New Orleans and Nashville. And the markets we think that will fare better would be like markets where there's a lot of tech and government jobs that can work successfully from home. So the Bay Area, DC, the Research Triangle, and Austin. So I'm hopeful. We've gotten through dozens of epidemics, more than 30 recessions and all kinds of 7 pandemics and 6 oil price crashes. I think Houston will come back stronger from this, but we certainly face an uphill battle.
So Justin, do you think that Houston's timeline for recovery looks different, better, or worse than the rest of the nation?
We do think that Houston's recovery will lag the national average, given the challenges going on in the energy space. But so we have 6 scenarios that we're providing to our clients. We're looking particularly at the baseline scenario and the severe downside scenario. There's a case to be made that industrial nationally could be moderate upside. And there's a case that retail could be more severe than what we have. But we, it depends on your outlook of how, successfully we're able to contain the virus, because we have all property types, increasing vacancy, decreasing absorption, decreasing rent growth over the next year, but that could go to 2 years if we have a double dip and we have a second outbreak in the fall, or if we contain it successfully and everyone in the public gains confidence that we're in a good place with the virus and people start going out again, then we could have a sharp recovery in the 3rd and 4th quarter and beyond.
So Jonathan and Trey, let's hear about, what's happening in your businesses. I think it's important to start with telling the story. So let's start with 2019. What did your company look like in 2019 in the first 3 months of 2020? Jonathan, let's start with you.
Yeah, for us, and I'll just say from a global sort of real estate perspective, while the equity markets, I think people felt were fully priced, the real estate market largely was in very good shape. I think so we were still looking. There were lots of capital availability, and we were looking to continue to push forward with new projects. We largely finished a lot of our pipeline in late 17 and 18, and really spent 19 working on, new projects such as East River and opportunities in, Austin and San Antonio mainly. And so, we felt like we were going to go into 2020 with the opportunity really to start 3 fairly large-scale projects, and really we're working on that all the way up until March, and then the world changed for us. So,
what about you, Trey?
Very similar to Midway, actually. 2019 was getting a lot of new projects out of the ground, in particular Cedarport on the east side, Park 8 at I-45, and the Belt. And overall, the capital markets were strong. We felt the industrial market was strong. I felt like possible overdevelopment in certain submarkets. I think that will correct itself in the balance of 2020. Some projects flat won't get out of the ground. But overall, very positive. And then you got into 2020 with a good head of steam, not dissimilar from Jonathan's comments, but oddly enough, our activity level, which we track in proposals and a couple other metrics, is double 2019 to date. So I think that's a combination of pretty good product, but also timing of deliveries. So, it's hard to read into that. I don't think it's been untouched. Certainly industrial tenants have been affected, but I think it's been a lot milder. If you drive to the east side, you wouldn't know what coronavirus was.
So let's talk about that. Let's talk about 2020, where you're at now. So Jonathan, what are you spending your days doing?
We have a company-wide call every Friday afternoon, and what I try to reiterate to people is we have 2 things we need to focus on, and one is the health and safety of our team and their families, and then 2 is really to fulfill our fiduciary responsibility to our partners. And really what that translates to is everyday active asset management. And so, that is dealing with a portfolio that ranges from hotels that are closed or have very minimal occupancy, retail to where we have largely all the retailers closed, some restaurants obviously providing to-go service, rent collections that are probably in the 25% range, to office that are largely vacant and nobody occupying their space, but actually, very positive on rent collections, 85, 90%, and 100% in many of our assets. And then multifamily that, has been impacted probably the least, but still requires very active asset management because you're dealing with people's homes. And so how are they dealing with coronavirus, and how are we shutting down or maintaining common areas? And to the extent we get notified somebody has coronavirus, how do we deal with that? And so across all of those assets, it's very much daily conversations with tenants, with banks, and with partners. And so it's quite a process, and I can't give our team enough credit for the effort they're putting forth. And really, I'd say, the first month was really that immediate shutdown. How do we deal with it? How are we proactive? And really now that's starting to, or has transitioned to now making sure we're prepared for what reopening means and all the implications of that. Still, in the meantime, dealing with potential, rent relief requests, loan relief requests and extensions. And so, it's a very active time from that standpoint, but that's what we do. That's your job as a fiduciary and a manager of investment capital.
So what, between the different tenant for your different asset types, what are you hearing from the different tenants?
What we're trying to achieve is, rather than dealing with kind of ones and two tenants, individual conversations at a time, what we've gone to both our tenants, our banks, and our partners is that on each asset, let's have a holistic approach to how we approach rent relief, to how we approach potentially restructuring the loan, and then to the extent we need to infuse capital into an asset, how do we do that from an ownership standpoint? And I think that's been received very well. In a way, it's sort of a calming approach to have a holistic view and to say, okay, if everybody gets on board with this, then we're all going to emerge successfully. And so for the most part, everybody is being very practical about how we deal with these things. And I think understand that if, as long as we all sort of act accordingly in the near term, then we can all be successful in the long term. And so, we're very fortunate, I think, to have good relationships across the board, whether that's with our tenants, with our lenders, or with our partners. And that's really what it takes. I mean, I think these type of situations really highlight partnerships and the ability to quickly be on the same page and deal with issues.
So Trey, we had talked about this before, but the industrial world is looking pretty different than what Jonathan is seeing. Can you tell me what your day-to-day looks like?
Once again, listening to Jonathan, we've done the same. We've taken a hands-on approach, which I think is calming, not just for us, but for our partners, for our lenders, tenants, our projects, and taking it head on and trying to be as active as you can. With offices closed, it's been a little bit of a struggle, communications at times, but we've used the lighter traffic to see more projects more often. And I've really enjoyed that, because when it's so busy, you just don't have the time to get to your sites as much as you'd like. So that's been great. The industrial market, with e-commerce, and you certainly hear it on news, on television, and so forth, how e-commerce, we've picked up a whole new wave of users generationally. So, we're trying to take that into the real application of responding to requests for proposals, but also what we've really been doing is working on our own housekeeping and taking that, trying to get better, with this decline in the financial side. We've seen obviously a reduction in interest rates. Across the landscape, we've seen probably on average about 50% of our budget has been less than pro forma, which is great. Adds to more carry potentially, and the ability to do deals that the tenants are looking for. So I think that's given us flexibility. But ultimately, I think the industrial market's in pretty good shape. I think in Class A, and I don't want to step on Justin, but you're seeing probably less than 10% looking for rent relief. As you get further down in to maybe the Class B, Class C product, lower clear height, smaller tenants, it's probably in that 25% looking for rent relief or rent concessions or so forth. So, all in all, we're trying to get better at our craft is really what we've been doing.
And Justin, is that what you're seeing in y'all's data?
Yeah, that lines up pretty well with what both Jonathan and Trey said, that office is showing the highest collection, followed by multifamily, and much less so retail. And the more high frequency groups like co-working and hotels, that you pay nightly or monthly, and that kind of stuff is getting hit the hardest, I think.
Yeah, so Jonathan, that was one of the things we wanted to ask about was co-working. So Midway has several co-working tenants, and that with the coronavirus and people wanting to distance, what are you hearing about how that's looking?
Yeah, it's been interesting. We're the largest co-working landlord in Houston, and we continue to believe in that format. I think, in many ways, co-working is a hospitality format for office, right? So it's shorter term leases. It's about flexibility and convenience. And, and it is no different than the hotel business. It's somewhat susceptible. Their income stream is susceptible to a downturn like this, to where if people feel like they can't occupy the space or utilize the space, then they're much less likely to continue with their membership. That being said, we've had, very good discussions across the board. We had a few of the national concepts not pay initially, and not the one you might think. They actually did pay, but and continue to pay. But we've had discussions with them, and I think their initial, non-payment of rent was really about, okay, is really getting their own house in order, and they've since stepped up and paid rent. And so, I'm a huge believer in it long term, and in many ways, and people have different views of this, but I actually think in downturns, co-working actually can benefit. If we do have sustained unemployment, which is unfortunate, I think you also see in those times, formation of new businesses, and so that very much speaks to the opportunity for people with new businesses to occupy those spaces. And so it's been interesting to watch, and obviously we'll continue to watch it very closely as this evolves.
So let's talk about a little bit about what we expect to see ahead in 2020. Obviously, we can't make any predictions, but from generally speaking, Justin, let's kick it off with you to kind of talk about what you're seeing, and then we'll talk to Jonathan and Trey.
Yeah, so we're already starting in our high frequency daily rent data. We're already starting to see, the effects of what's going on, which started the end of March and continued into April. I think it's going to be at least a quarter or two before we start to recover, but then from there it becomes more uncertain. And it's all about consumer confidence. And as quickly as we can lead the public to be confident that the coronavirus is contained, that people are comfortable to be in crowds, the quicker we can get this economy back up and running. So there is a lot of uncertainty about the momentum of the economic recovery still, I think, even as most states are kind of reaching their peak of cases. So, but, longer term, I think that Houston, like the Sun Belt, or Smile States peers, however you want to group Houston, will continue to ride that wave of, things like, affordability and warm climate and low taxes and a pro-business environment, those kind of things that have drawn so many people from the coast to Texas. But I don't think it'll happen in a vacuum, particularly with the crisis that the city of Houston's budget faces as a result of what's going on in the energy space in particular. So it's going to take, I think, a pretty concerted and continued public-private effort to continue to foster biotech and med tech and digital tech commercialization, and to attract corporate relocations away from Dallas, and to do all those kind of infrastructure things that we need to do to continue to remain competitive.
So can you dive a little bit deeper into what's happening with oil prices and what would cause a recovery towards a sustainable price levels, and when might this occur? That sounds like that'll be big for Houston.
Yeah, sure. So I'm sure everyone saw the negative oil prices last week, which is something we've never seen before, and now oil prices are in the teens. The main culprit of that is much less the Saudi and Russia oil price war they just had, and much more so the fact that there's been a 30 to almost 50% drop in global demand for oil and gas as a result of the quarantine, which is something the energy space is not prepared for as it operates on the margins. That's created storage issues. And so, global oil and gas demand needs to basically rocket back in order for prices to recover to a sustainable level. From what I understand from the Dallas Fed is that, and friends in the industry, that the companies need $20 to $36 oil just to cover operating expenses for existing wells, and $40 to $50 a barrel to drill new ones. And from looking at the futures curve, that price tops out at $31 middle of next year. So, I mean, it could be again, depending on how quickly we recover, it could be, a year to 2 years before you start to see pricing, probably closer to 18 months to 2 years before pricing recovers to a level where we see another uptick in energy activity. And the energy space has cut 60% of CapEx this year, something like over $50 billion in new projects. So I do think that we'll see more layoffs and consolidations, tragically, unfortunately. And, we're just hopeful that global demand can bounce back, as quickly as possible.
So Trey, for 2020, looking ahead, we're hearing from Justin that, there's a lot that has to happen in the economy. What does 2020 look like for you? What are you expecting?
To energy, industrial is so much less affected, other than crane served facilities. Houston's industrial market is just largely unaffected. If you look at 2014 and the price decline, then the trailing quarters were largely unchanged. If you actually remove new projects, vacancy levels obviously would go down. So, I don't know how to address, I don't know where that goes. I'm cautiously optimistic on that front. As for the economy, I don't know. I think that our summer could be quite busy. I think there's an equal chance that it could be kind of quiet. I do think it's going to pick back up at the end of the year in Q4. And I think 2021 probably looks a lot better. So
if you had to look over the next 5 to 10 years, what would you say is the single largest driver of demand for Houston industrial?
The single what?
Largest driver of demand in Houston industrial?
Consumer. When you look in particular online sales, e-commerce, however you want to call it, and you look at what Amazon's doing right now, I think you will also see other retailers follow, and you're seeing that across the board.
So, go ahead.
Some are using their locations as delivery points and supporting them through their distribution facilities. I know that most of that was going on last year in the positioning with Home Depot and Lowe's and Target. Walmart has done a particularly good job utilizing their stores and their distribution facilities to support that. But yeah, I think e-commerce just continues. I don't think retail ever goes away, though. Sorry.
That's probably good news for Jonathan.
That's what I was.
So, Jonathan, for looking ahead to 2020, without looking into a crystal ball, what is it that you see?
Well, I'll sort of take a macro view and then sort of tell you, more specifically for us. I think if you look at the REIT index, right, which is the publicly traded real estate, you see average values down about 20%. You can certainly drill down to certain sectors where, hospitality is probably down 50%, multifamilies down less than 20%. And so, but if you kind of take that as a barometer, but that's, that is a measure of assets mark to market on a daily basis. For those of us in the private side, along with our institutional investors, we mark to market every quarter. We've gone through a Q1 revaluation, and essentially what we've heard across the market is people are not changing cap rates or discount rates, but just largely trying to reforecast income. And obviously we'll all have to go through that again in the second quarter, and that might paint a different picture. But the sense is, values really on a longer term basis are maybe down 5 to 10%. And I think that's just based on the idea that you're going to have some hit to cash flow due to occupancy decline and some less or less rent collections. And so I think from a looking forward, our perspective is kind of slower, longer. I think how things come back, and if we think through our portfolio, hospitality and travel, I think is going to take much longer to recover. And so if you think about in Houston specifically, international business, largely driven by the energy business, is a big part of our travel market. I think international business is not going to be allowed for an extended period of time. If you think about hospitality driven by events and gatherings, that's probably going to be slower to recover. We're still not going to be having big events. And I think, largely just for the safety of their employees, companies are going to curb travel unless it's absolutely necessary. And so while we're a big believer the hospitality market's going to recover, it's just going to take a while. It's not going to be like flipping a switch. On the retail and restaurant side, we already have some folks reopening based on the state changes. But that being said, if you think about a restaurant opening up at 25% capacity, I think some are questioning whether it even makes sense to be open at 25%. Can they even break even at those numbers? And so it's going to require, at least getting to 50% plus to really make sense and for them to start making money again. That being said, we have a number of retailers that are open, and I saw people walking into the Kendra Scott this morning, and so apparently there's still demand for jewelry, but that probably never stops. So, and then on the office side, I think as I said, that remains fairly strong. Obviously, on the demand side, I think we're going to see companies probably do short-term extensions, stay in place, and really evaluate strategically how they think about office. And we do think there will be some shifts, maybe not dramatic, but shifts on how people think about, what they've learned from this experience. How can they leverage, the idea that they can have a distributed workforce and maybe they don't need to be in the office every day. And so while we don't have a crystal ball, I think people might think differently about the density of their space. Can people work a certain number of days from home? And, on the West Coast, just sort of anecdotally, we heard Google already canceled a 2 million square foot lease in San Francisco and a 500,000 foot lease in Seattle. And it's not that they won't do it, but they've sort of made the global comment they're going to sort of pull back. And so you might have a company like Google say, look, the ability to, and they were probably already very technically advanced versus some of us, but they might say, look, this distributed workforce works, and the impact is not that we're not going to have offices, but it may be that we can have offices in a lot of other places, and potentially in places with lower rent cost and lower cost of living, which might be a big benefit for places like Texas. And then on the multifamily side, I think it's really a story of unemployment. So, people are going to continue to need places to live, but I think if unemployment continues to be tough and we don't get a recovery in jobs there, then certainly multifamily is going to feel that. I don't think to a large extent, but certainly to some extent. And the other thing I'll say just from a macro perspective, and I think the benefit, post-financial crisis for real estate is all real estate has a lot more equity and a lot lower leverage. And the banks are being very practical from what we're seeing. And so, there will be, I think, bankruptcies and some assets that go back, and that might create opportunities. And we're certainly going to be looking for those, but by and large, I feel like the industry is going to fare this well, and we're going to come out the other end just fine.
So Jonathan, you had said earlier, y'all had some deals in the pipeline. What have happened, with those deals, like in their various stages?
Yeah.
Have financing, don't have financing, they're under construction, in the various stages. What's happening with those?
So in all of those cases, those are situations where we control the real estate, meaning we control the land. And so, building the 6th office building at City Center or another office building at at Levy Park, or our project East River on the east side of Houston, the old KBR site. And so, they don't go away. It's just a question of when do we start, and we have both bank financing and equity financing secured, or partners in all of those. And so I think it's just going to be a process of seeing how the market unfolds and trying to capitalize on opportunities. Amazingly, at City Center, we've had one tenant request to expand by 25,000 feet, an office tenant. We've had interest from a very high profile retail tenant that still would like to called us and said we'd like to expand the location and be open by Christmas if possible. And so, amidst what seems like a pretty tough environment, there's still opportunity. And the reality is people have to operate their businesses, right? I mean, while we sort of have this sense that the world stopped, well, that's not the reality. I mean, Trey's running his business, Justin's, running, his company. Lyndsay, you're still doing work for clients, and we're still working. And so, so I think we have to sort of disconnect maybe the social notion of the world stopped, but the reality is business continues on, and people will need to think about how that impacts real estate and their needs. And, it's the same at East River. We have a fairly large potential build to suit opportunity, and we're still having those conversations. And so, again, I think it's going to be slower. The opportunities are not going to go away. It's just, will we be able to start them this year, or maybe will they start next year?
So Trey, there is a record level of new spec development in Houston. So for 2020, does that concern you at all? And what might make some spec winners versus others?
Well, what we're hearing both in on the ground is a lot of projects have been that didn't have a shovel in the ground yet have been postponed, delayed. I think some of the projects will continue with their design side, their permitting and so forth, and get ready. So far, I think it was out of the 20 million. Justin could probably speak to this better. I've heard the number close to 3 to 4 million square feet has been tabled. Out of that, the remaining balance, about half of that is either owner occupied, build a suit. I'm not a market statistics guy, but we watch it in particular submarkets. I can give you example after example of projects that were tabled, set aside. Some of that was less about coronavirus and more about the price of oil and capital market pressure. So I think some of those may come out of the ground in 21 or even late 2020. I think that's going to be a complete function of the market. So those that have buildings that time out in deliveries may be in a better position. But also I think as Jonathan said, I think you're going to see market opportunities as other guys either move out, those development groups and investment groups move away from Houston due to oil and the pressures from the capital markets or the REITs, and leave more opportunity for others. So
I think that's a great point. I mean, and we've seen it in every cycle, but we tend to actually find more opportunities in down cycles because the playing field gets thinned a little bit. And so I think for those of us that have a long-term view and committed to the markets, we'll likely find some really good opportunities. We're actually, and the bankruptcy didn't start in coronavirus, but it was a deal we had been tracking in buying a fantastic site in San Antonio, and we had tracked it the whole way through. And I think the fact that the bankruptcy process then overlapped and went into the COVID situation really thinned, the buyer field. And so fingers crossed, but we should be closing on that tomorrow. And so, I think we'll, if you're adaptable and flexible and entrepreneurial, I think there will be opportunities.
And I'll echo Trey's comments. So 20% of all the new construction is 3 build-to-suits for Ross, Dollar Tree, and Medline. And there actually could be a great opportunity near the Port of Houston for plastic storage if they're pumping out a lot more of it, and it's been, deliveries have been halted. So there will be winners and losers with the new spec product, I think.
So Justin, kind of piggybacking on, the opportunities, we had talked a little bit about, you've talked a lot about resiliency in the past in Houston. So what positive signs do you see in Houston's history of bouncing back from recessions and force majeure?
Yeah, absolutely. I mean, Houston truly is more diversified. I'm not sure how much, but we do have, a very robust financial services and professional services sector. We've got a very robust medical center, of course, and rely on global trade. And so it's not just oil and gas. That's only half of the story. So as soon as the global and national economies can bounce back, I'm pretty confident that Houston can bounce back, and that it will continue to be an attractive place for people to live and to move to. And certainly in terms of opportunity, echoing what Jonathan said, this is a time, when folks are looking for buying opportunities and looking to really make investments in undervalued assets. So it's not all bad, and we remain hopeful for recovery. Oxford forecast is their baseline that we get back to February 2020 levels of economic growth as a country within a year. So hopefully that's the case, and fingers crossed that this gets contained, and that people can get back to work, and the economy starts going again second half of this year.
So we've already started getting some questions in, so I'm gonna move over to Q&A. 1 second.
Lyndsay, can I add one comment about,
Please go ahead.
I think Houston is still very much an energy town, and in many ways the energy capital of the world, but I do think we've done a good job in continuing to diversify. And so, a lot of the work that's being done about like innovation ecosystems and those kind of things, I think continues to be really important as a focus. And similar to my comment about co-working, and we saw it in the last oil and gas downturn, is a lot of really bright people end up having opportunities to do other things, which is a lot of times, new business formation. And so, we're fortunate to have both, Amazon Web Services and Google as tenants. And those are people that were not here a couple of years ago. And so, I think you sort of, while oil and gas is an important industry here, we have to, continue to support all the efforts to diversify the economy. And innovation is I think a huge part of that. It's, if you can have innovation be a strong part of your economy. And I think what people forget about oil and gas is it's a largely technology driven business. And so we have a ton of really smart people who have skill sets that don't necessarily have to be applied to oil and gas, but can be applied to any type of sort of technology based businesses. And so I think we still stand to fare well in that regard, and have a good runway in front of us.
And I don't think that the energy headquarters are going anywhere. I think that Houston will be much less impacted than like an Oklahoma City or even a Midland, as we saw during the last full downturn, that those companies, they might shrink a little bit, but they'll stay here in this cluster.
Thanks, Jonathan. So Jonathan, I think you kind of already hit on this, but let's go back to it. So what are your expectations for rent collections in the multifamily space over the next few months, which I think is interesting, because, as what Jonathan was and what Justin was predicting is that, this is going to continue, and then any early indicators that you might see. Right.
So it's going to be interesting. So essentially we've been through the April rent collection cycle, and we're just about to go through the May collection cycle. My sense is across, the office and retail, we fairly well know what the status of the tenant is, where we are in our discussions about potential rent relief, and whether, they're going to be paying rent. So really May is about multifamily. And I think as I said, it really comes down to unemployment. And so our hunch is May might look worse than April and June might look worse than May as kind of companies figure out what they're doing. People make, job cuts, whether those are, furloughs, payroll reductions or just pure layoffs. And so it's going to be interesting to see, but our sense, and I think a lot of the folks we've talked to across the country is May might look worse than April on multifamily, and June might look a little worse than May.
And Justin, what are you seeing in y'all's data for multifamily?
Yeah, so we've seen that, like for Houston, rents have declined 2% already since mid-March, and which would be 14% annualized. With real estate, there tends to be lag effects. So something we've done in our forecast is we've smoothed out the massive unemployment numbers over 3 quarters to try to reflect that on the real estate side. Again, in terms of multifamily, it seems to be holding up pretty well. I mean, nationally, we've seen something like 75 to 80% of renters paid last month. I agree with Jonathan that the longer this drags on, the worse it could be in terms of rent collection.
So Trey, there's been a lot of talk about an increase in online ordering during the pandemic, especially for essential goods. Is this something that you're witnessing occurring with some of your tenants in your portfolio, that you're hearing from, others in the industrial world?
Yeah, what we're hearing and the brokers, not just in Houston, but Texas as well as across the U.S., is they are seeing early inbound inquiries for new logistics and distribution centers, some repositioning, some growing substantially. I do think you're going to have a lag effect of that, both in timing, but also seeing what the landscape looks like. And I think you'll see movement.
Yeah, and Amazon and Walmart. I mean, there's some companies that are just still growing like crazy in the industrial space.
So, Jonathan, this is a interesting one. Jonathan or Justin, y'all might be able to answer this one, but has there been any impact on properties with lower tenant occupancies due to COVID-19 from criminal activities? If so, what steps are you taking to address this?
Yeah, I don't know the answer relative to statistics, but it is certainly one of the things we've thought carefully about and acted upon across our portfolio. Is when you have assets that are largely unoccupied, does that sort of yield the opportunity for crime when activity is low? And so we have not seen any issues across our portfolio, but at the same time we did increase security to make sure we didn't have any occurrences.
So this question, I think, could be a good one for all of you. Some veteran real estate investors have likened this downturn to Houston's '85 crash. This participant's interested in getting all of y'all's perspective on this comparison. Trey, do you want to kick us off?
Yeah, we've had a lot of that. We've had a lot of that discussion, given that I started just shortly after that in the abyss, which was a wonderful training environment, because in my opinion, it could only have gotten better, and it did. I don't have that feeling. I think the capital structures are so completely different. I think the equity and projects are so different, to the better today. If you look at just the ownership of industrial real estate of all calibers, so much is REIT and or private REIT, and they're not. It's not linked to. I mean, in the 80s, you had guys putting 10-20% on their own deal. Not a lot of depth behind that as individuals or a group of individuals. It was a lot more limited. The debt levels were much higher. The interest rates were much higher as well. We're in a pretty good interest rate environment now. Not good, but I would call it great. which I think helps a lot. It helps in your hold, helps in your underwriting, it helps to tenants. Cap rates, I think, yeah, we've probably seen a short-term move. I think in Q3, Q4, I think it'll go back. I think there's an argument to be made that it actually gets stronger. I think you're going to see a flight again to assets like real estate away from the stock market. I mean, these things just continue to push equity. I think we'll also see more foreign capital move in on all asset levels.
I agree with Trey. I mean, I think it's very different from 85. 85 was really the savings and loan crash, a big change in tax law relative to real estate, and you had the oil and gas collapse, and that was a confluence of sort of economic and systemic things. Whereas here, I think we have to remember this is not an economic caused downturn, right? This is a sort of a health and pandemic caused downturn. And to Trey's point, those are the days when people were borrowing 110% of their project costs. They had either little to no equity in the projects. And so things unraveled pretty quickly. And agree that there was much less institutional sophistication in real estate at that point. Today, real estate is a major asset class and a major percentage of large institutional investors, whether that's pension funds or sovereign wealth funds and others. Certainly a big growth in the REIT markets. And so, today I just think fundamentally real estate is in a very good place, and also agree with Trey's comment in basically a zero interest rate environment. Where are people going to go to find yield? Real estate is going to continue to be one of the great places to find yield in the near term.
So in 1985, I was barely alive and kicking, but I'm probably less qualified to speak on this question. But based on what I've read, I agree with everything that these guys said, that the real estate sector is a lot better capitalized. The financial sector is in a lot better shape after 2009. And, oil prices are lower, and the energy industry, I think, faces more severe challenges perhaps than they did in the 80s because of that. But again, Houston is more robust, more diverse, and, more of a fortress, play than it was in the 80s.
So Jonathan, this question is going to be best for you. What areas of Houston do you see the most demand in retail once we're out of the recession?
What areas will have the most demand?
Yeah. What areas? I think what areas of Houston do you think will have the most demand in retail? So do you see it being in, in Memorial and City Center? Do you see it in the Gallery? I think it's the question.
Yeah, I don't think that is going to change, much. It's still, obviously, retail is driven by residential population and the makeup of that population. I don't see that drastically changing in the near term in Houston. The question is the consumer going to be a little weaker relative to unemployment or not? I think that might have a slight impact, but not much. And we might even see, as things fully open, a bigger surge, and just that people are, just socially excited to get out and get back to restaurants and, be in social environments. And, for us, it's been a little odd. This situation is the polar opposite of essentially what we try to create on a daily basis, which is, a community destination where, people love to go and see people and be seen. And so, I think, public health and safety is first and foremost. And so hopefully we reopen in a productive way, but we're very optimistic about the consumer being there once we get back to our full stride.
So this is a good follow-up question that happened to come in after, but with companies proving that they can successfully operate with employees working remotely, what level of concern do you have for a major shift to remote work? Which I also think is interesting because there was a lot of open office concepts that occurred within the past few years. So between that and then remote work, what do you see?
Yeah, I think it's too early to make a prediction. My sense is it will have an impact. It won't be a major impact. And so similar to my comments about Google, I think people might in the near term pull back and sort of really try to think through, what are the opportunities to either reduce or change how they think about real estate. I don't, I think there's a natural immediate reaction to think people will want less dense office space. Today I think people think about office as part of their brand, as part of, recruiting and retaining talent. And so I don't think that's going to change. Densities might change slightly, but my sense is I don't see a radical impact there. But as I said, I think companies, to the extent they think people can be more dispersed, it might actually benefit markets with lower cost structure, like Texas versus say an East Coast or a West Coast.
Yeah, I mean, I sit on this national thought group committee, and we talk a lot about this. I think it's still pretty uncertain. To what Jonathan said, in higher cost metros, I think they're going to make dollars and cents of people working from home more often. But then they have to counterbalance that with social distancing measures, and perhaps in some cases you'll see companies actually increase their floor plan in order to accommodate distancing. And maybe the ways that companies think about office design going forward might save some of the collaborative space element, but then also spread people out a bit more. But we'll see. I think people have a short memory, and hopefully when this blows over, people will kind of go back to their more or less their normal habits. I think the effect could be somewhat neutral, but I do see big office tenants using this as an excuse. I mean, you can look at DLA Piper in Austin or Google, as Jonathan mentioned. I'm not so sure how much of that is they're saying that, everyone's going to work from home now, or that they're using it as an excuse during this difficult time where they're considering layoffs to back out of leases. Yeah. But overall, I think the effect might be somewhat neutral.
So last question from our Q&A. And this is for any one of you that can answer, but interest rates are lower, but do you see banks being more conservative and slower to lend until the landscape clears?
I'll take that just based on kind of existing conversations, and I would put equity in the same bucket. I think for the most part, banks and institutional investors are going to spend 2020 trying to figure out, what they have in their portfolio, trying to understand values and trying to make sure their investments and their loans are secure and positioned for long-term success. And so I think they might be willing to lend on very strong relationship basis on opportunities that make sense, but I think it'll be limited. And, I think people will really get back to looking at, new opportunities, whether that's lending or equity investing, probably in 21. But I just think we're going to go through a little bit of this active asset management process, this process of reopening, and this process of value discovery. And once everything settles a little bit, then I do think everybody will be looking for opportunities.
I agree. I think the overall is, I think it's relationship. I think that will be and will always be, and will continue that way. I think the pressure probably on the banks locally will be the effects of energy and how that affects their overall. But it depends again to the asset class in real estate. So well located, well capitalized, well sponsored projects always will go. So
yeah, and Trey makes a great point. I mean, it will also be very product specific. The likelihood of making a hotel loan versus an industrial loan are radically different ideas.
Well, I want to thank y'all for being here today, and we really appreciate y'all taking time out of your busy schedules. I'm going to ask you a closing question for each one of you to answer, and that is, what's keeping you up at night? What's the most pressing thing in your mind? Jonathan, let's start with you.
So mine is my 21-year-old that has a bedroom above us that should be a college, and he's awake at 3 a.m. when we're trying to sleep. So that's my answer.
What about you?
I'm probably just worried about my parents who are in their late 70s and very, very concerned. That's probably one of my greatest concerns, you know, and my friends' parents as well. So that's been tough.
Yeah, absolutely.
Yeah, and you know, I'm just hoping that we can get this virus under control and everyone get back to their normal lives and their social lives soon. And you know, CoStar is certainly not immune to, you know, downturns, but we had a good quarter last quarter, but it was, you know, 2 good months and then a 1 pandemic month. So just, you know, hoping that we can ride this out like everyone else and keep our people and you know, get back to normal life.
Yeah, absolutely.
See you all in person.
I'm ready for normalcy.
For sure.
Well, thank you guys again for your time today. For more information about BoyarMiller, please follow us on LinkedIn. If you would like a recording of this, a recording will be sent out soon. BoyarMiller will be pushing it out on LinkedIn and Facebook. So please follow us, and we thank you all for joining us, and thank you all for today.